Hello, welcome back. And today I'm going to go over some very important headlines. So I'm going to share my screen and let's get started. And according to Housing Wire, this news trends are very interesting. The headline is Mortgage Rates Reverse Sharply as Market Goes Wild. This is chaos. Let's go over how the mortgage rates are impacted by all this volatility and the most important direct correlation between the mortgage rate volatility is not necessarily the Federal Reserve cutting their rates. It is all about the 10-year Treasury. The movement of the 10-year Treasury pretty much directly impact what direction the mortgage rates are going. So again, I just want to emphasize this very important point. So with that in mind, and let's go over some of the first paragraph in this particular article. The past few days, as I'm speaking to you, 9 April, the past few days has been highly turbulent for the stock and bond market. Again, the bond market, the 10-year Treasury yield pretty much impacts the mortgage rates pretty dramatically. And that's what's happening. The mortgage rates pricings are impacted by the bond market. So with chaos enters the marketplace, it quickly makes its presence felt. So without the recent tariff news, we likely wouldn't have seen mortgage rates drop to a year-to-date low last week. And we can go over the mortgage rate momentarily. However, here's why we have the significant reversal in yields that's the author of this article has been talking about. So here's the visual of the 10-year yield over the past few days, according to the Housing Wire. So when the 10-year yield decreases, the mortgage rates follow suit. So they trending along with each other. As recent as March last month, as you can see, is the mortgage yield is around 4%. Typically, if the mortgage yield is 4%, the spread is around 2%. That means the mortgage rate is like 2 basis points higher. So if the mortgage rate around 4.3 a few months ago, the 10-year Treasury is around 4.3, then the mortgage rate is probably around, again, 2 basis points higher, which is around 6.5%, around that range. Then, as you can see right here, ever since March 27th, the 10-year yield has been decreasing to a point where around last week, around April, the beginning of April, we have seen the 10-year Treasury lower to 4%. So that's why you have seen mortgage rate has dropped as low as 6.6% last week. Now, the 10-year yield has gone back up all the way back to 4.2%. That's why we have seen the mortgage rate as of today, 9 April, according to the Mortgage News Daily, which I will cover momentarily, have gone up to 6.85%. The labor markets impacts the 10-year Treasury. Consequently, it impacts the mortgage rates volatility. We have seen a series of economic data points weaken, which has resulted in lower 10-year yields and mortgage rates from their peak. One thing is, again, the mortgage rates decrease whenever there's bad economic news. Whenever if there are like volatility, if there are negative economic news, anything negative like unemployment has gone down a little, if the labor market has gone down, any kind of economic uncertainty, it brings down the 10-year Treasury. Consequently, the mortgage rate gets decreased. It's weird to any adverse economic crisis news impacts the 10-year Treasury, makes the yield go lower, and consequently, the mortgage rates decreases. So that's how it goes. When you have good news, when you have very good, strong economic trends, if that's what happened, the 10-year yield goes up and the mortgage rates goes up. So it's just the psychology of the market is so strange. So it's definitely we've gone through some challenging times, especially the past 2 years. But as you can see, the 2024 last year, the spread between 30-year mortgage and 10-year Treasury security yield has decreased. That's why the mortgage rates this past 2024 is slightly better than 2023. And then 2025 is slightly better than 2024 year to date so far, 2025. So here's that article. So let's go ahead, go through another article reported by this individual, John Malloy, according to a CNBC article here. And the headline is Bonds Crater, 10-year yield spikes briefly above 4.5%. Again, if the 10-year yields around 4.5%, the mortgage rate typically 2 percentage point higher, which is around the mid 6%. Confounding move that's worrying Wall Street. See, now it's kind of weird. The Wall Street, the situation Wall Street affect housing. The Wall Street affects Main Street, if you will. So again, it's all about the bond market. The bond market dictates the mortgage rates. So the bond market, not a plunging stock market. It's the talk of Wall Street with prices tumbling and yields spiking. Unusual action during times when fear of recession, the R word, we might see what I call a housing recession. It's not all that bad. Housing recession it's a technical term. It may not bring down housing like the perception you might have out there. The fear of recession are growing where fixed income is typically considered a reliable, safe haven. When there are stock market volatility, when the stock prices goes down, then the bond market gets better because all the investors are moving into the bond market. So that drives the bond market the yield to go down, and therefore it makes the mortgage rate come down as well. That's what's happening. The 10-year Treasury, once again, it has gone down briefly a few weeks ago. That's why we have seen the lowering of the mortgage rate. Trump has started this trade fight with the world. Yes, Trump is making a name for himself. It was mind-boggling. So equity prices have tumbled. The stock market has gone down with the S&P 500 losing 12% in only 4 sessions on growing worries that Trump has triggered a recession. So far, this is only the first year of the Trump's administration, and President Trump has impacted the stock market, the housing market, the global crisis, trade war, tariffs, and inflation, everything. I don't know. There's a reasoning. Trump is a mad scientist of the world right now. It's the president scientist. He's impacting. But there's a silver lining, by the way. There's a reason why Trump wanted to do all this. He want to make America great again by creating a tariff from imports especially from China. So ultimately, I think Donald Trump wants America to be in the forefront of manufacturing. He wants to create jobs in manufacturing based in the U.S. ultimately, so America does not have to rely on foreign imports. So that's what's going on. I wouldn't dish on Trump as of yet. There's something going on. He's trying to make the American economy down the road. He has his long-term plan to make American economy great again. That's why we're seeing this crisis going on. So there's a silver lining. I don't know. I bet you in the next before his administration is over, Trump has 3 more years, 3.5 more years being president, unless something bad happens to him. But by the end of his administration, we could see America economy is to become once again the strongest in the world. And there's some positivity going on, and you have to think beyond the current narrow scenario that's happening right now. You have to think long term. There's something going on. There's a lot. The long term, what Trump is doing could have a positive impact in America in terms of the economy, in the political stability, and everything else, labor market, and so forth. So let's get back. So the move higher for yields is trouble for both the Trump administration and the Federal Reserve. The White House for a time could have taken solace that tumultuous tariff rollout was at least lowering rates, at least temporarily, providing a buffer for consumers. But then the rates rebounded this past week. So Trump administration officials have been taking credit for the recent drop in bond yields and mortgage interest rates, wrote by Ed Yardeni of Yardeni Research in a note Tuesday evening. Unfortunately, the 10-year Treasury bond yield is back up again. That's why the mortgage rate has gone back up slightly in recent days. Meanwhile, oh my gosh, that's it for this article. And finally, I want to go over the Mortgage News Daily, which I follow, which all of you should follow. Is the most credible, the most mainstream that reports mortgage rates on a daily basis, 24/7, 365. As you can see, 9 April, today's date, they got this recording, the 30-year fixed rate mortgage with people with excellent credit are 6.85%. And if you go over this past year, as you can see, so it's pretty volatile. Back in April, it's the beginning of April, 7.45%. Then it dropped all the way to 6.15% on last September 2024, the mortgage rate dropped to 6.12%. Wow. Then it went all the way back up to 7.25% in January 14, 2025 this year. And then since January, the high of this year, 2025, the high of 7.25%. Then the mortgage rate has gone down pretty steadily for the past few months, as low as 6.64% last week, April 1st, now back up to 6.85%. In fact, since I'm on this chart, let's go over the 5-year mortgage rate changes. Back in April 2020, at the peak of the pandemic, with a mortgage rate like 3.3%, which is historical high. That created the pandemic housing boom and skyrocketing of housing prices. And then everybody refinanced back in the pandemic. And now we have seen the lock-in effect of all the homeowners that are the amazing rates, which is quite nice for those people able to do that. So we have a lock-in effect whereby people are not selling their homes, because why are they sell the home at a 3% mortgage, then buy a replacement home at 7 to 7.5%, essentially doubling their payments. So people are not moving. That's why we have a severe lack of supply in the housing market for the past few years. And then since the middle of 2022, the mortgage rate, the Federal Reserve, they increased the mortgage rate. They didn't increase it, but then since the fall of 2022 until now, we have seen the mortgage rate skyrocket from as low as 3% back in 2021, less than 3% 2021, all the way up to as high as 8% in October 2023, and now has gone back to 6.8%. So suffice to say, we're living in a mortgage volatility world. So it's really hard to plan for people who are trying to enter the housing market and everything else. It's just mortgage rates has impacted the housing market so significantly. while we at it at the chart, look, you think the mortgage rates are high at this particular moment in time. Look at back in the 1980s. I know a lot of you have no clue what's going on. Back in the early 1980s, we have seen the mortgage rate as high as 17.59%, almost 18%. That's mind-boggling. And at that time, we didn't see a housing crash. So the mortgage rates by itself, doesn't matter how high or how low, does not necessarily mean there will be a housing crash. So see, now today's rate, 6.85%, is pretty average on a historical basis if you go back the past 50 to 60 years, as you can see by this chart. But then what we saw is back in 2 decades ago, around 2001, the mortgage rate has really decreased pretty substantially to around the early 2000s, 5%, 5.7%, then all the way down to 5% mortgage rate back in 2010. The decade of 2010, we have seen mortgage rate between 4 to 5%. Wow. See, those are good old days. But then of course, the pandemic happened in 2020. We see a historical low rate of around 3% for a lot of people, which is absolutely shocking. Now the rate has gone back in the past 2 years, 2.5 years, to the current rate of 6.85%. So what's my takeaway? My takeaway, there's a lot of crisis going on. Like I just mentioned, the tariff, the inflation factors and Wall Street, and just impacting Main Street. And so expect this mortgage volatility is going to happen at least for the remainder of this year. If the mortgage rate come down to maybe 6%, then we may see a demand, people getting off the sidelines to enter the housing market. But until then, the market is really frozen. So prepare, continue to see all these negative sentiments going on. So we have to watch the labor market. We have to watch the 10-year Treasury, and then all this, the tariff news and the economy. So in the labor market is also important. That impacts the 10-year Treasury yield. So negative news, negative economic news, for the most part, decreases the mortgage rate, and that's what we're seeing. So I want to hear your thoughts to see, are we in a recession, a housing recession? Are we gonna this housing gonna come bring down? We still have a supply and demand imbalance. According to the Redfin, we have like around 4 months supply of the inventory nationwide. That is, so 4 to 6 months supply of inventory is a balanced, healthy market. We are a little bit of a buyer's market in some parts of the country, like in Florida or Texas, but we have a seller's market in the Midwest. The housing market is really regional. It's not a national housing market, although we talk about national housing market quite often, but housing market is local. So as a homeowner, it's hard to plan your long-term housing future, given all this volatility and all this negative news going on. But at the same time, look, if your situation is such that you have to do something around housing on a personal basis, then you do what you got to do. If you need to buy a house as a primary homeowner, if you're ready to do it based on your personal reasons and you qualify, if you have a long-term perspective, there's nothing wrong to buy a house at this moment. Waiting is not going to help you that much. But if you're as a real estate investor, which what I do, there's always deals. It's not the way real estate investors make money, create wealth is not solely about the mortgage rate. You look at other factors in order to become a real estate investor. If you want to learn more about that, you could subscribe to you put your email on my website, so you can become a free member of our real estate investing community. So therefore, you can receive free content into your email inbox on a weekly basis, where you can learn more about real estate investing. Other than that, if you receive any value from this video, please like and subscribe to my YouTube channel. I provide weekly contents around what's happening in the general economic news, general housing news, what's impacting your situation so you can become a more of an informed home buyer or informed investor. And of course, I put out real estate investing contents, how to buy income properties, how to become an investor, and so you can create wealth long term. That's all I have to say. Thank you for watching, and I will see you next time. Bye bye.